Before we dive in, a quick but important disclaimer. I am not a financial advisor, and this video is for informational and educational purposes only. The information presented here should not be taken as financial, legal, or tax advice. A reverse mortgage is a complex financial product with significant implications. Please consult with a qualified and licensed professional, like a financial advisor and a HUD-approved counselor, before making any decisions about your specific situation. Alright, let's talk about the promise. The American promise. You worked hard for 40, maybe 50 years. You played by the rules. You diligently paid your mortgage month after month, year after year, turning a house into a home. You built a nest egg, you saved, you sacrificed. And now you've reached the summit. Retirement. The golden years. But for millions of Americans, those golden years are starting to look a little less shiny. Social Security helps, but it doesn't cover everything. Your 401k looks more like a 201k after a few bad market swings. And inflation is the silent thief, eating away at your savings every single day, making that fixed income feel smaller and smaller. You start doing the mental math. You look at your savings, you look at your expenses, and you ask the terrifying question: will I outlive my money? It's the fear that keeps people up at night. The fear of having to sell the home you love. The fear of becoming a burden on your children. The fear of losing your independence. But what if I told you that for many of you, the single biggest financial asset you own is completely untapped? What if the solution to this anxiety isn't in the stock market, but right under your feet? I'm talking about your house. For the average American homeowner over 62, a staggering 70% of their entire net worth is the equity locked inside the four walls of their home. It's a multi-$100,000 savings account that you can't access. It's a sleeping giant. And there is a key to unlock it. A tool specifically designed for this exact situation. But it's a tool that is wrapped in mystery, confusion, and frankly, a lot of fear. You've heard the name. Maybe you've seen the late-night TV commercials with the smiling, silver-haired actors on a golf course. Maybe you've heard horror stories whispered at family gatherings. The term is a reverse mortgage. And right now, half of you are probably ready to click away. You're thinking, oh, one of those things. Isn't that a scam? Isn't that how you lose your house? Stick with me, because my goal in this video is simple: to pull back the curtain and give you the unfiltered truth. We are going to cut through all the noise, the confusing jargon, and the sales pitches. By the end of this presentation, you will understand in plain English exactly what a reverse mortgage is. You'll know how it really works, not how your neighbor thinks it works. We'll cover the good, the bad, and the ugly. We'll talk about the powerful benefits, but more importantly, we'll stare directly at the risks and the costs. We will bust the biggest myths and answer the toughest questions. And most importantly, you will have the clarity to determine if this is a financial tool that could potentially secure your retirement, or if it's something you should absolutely stay away from. This isn't a sales pitch. This is an education. So, let's start with the most basic question. What on earth is a reverse mortgage? To understand a reverse mortgage, you first have to understand the mortgage you already know. A regular, traditional, or forward mortgage. For 30 years, you've been in a relationship with your bank. Every month, you send them a check. With every payment, two things happen: your loan balance goes down and your home equity, the part of the house you truly own, goes up. It's a one-way street. Money flows from you to the bank. A reverse mortgage does exactly what the name implies. It flips that entire dynamic on its head. It reverses the flow of cash. Instead of you paying the bank starts paying you. Let me say that again because it is the entire concept in a nutshell. Instead of you writing a check to the bank every month, a reverse mortgage is a loan that pays you. You are turning a portion of that equity you've spent a lifetime building up into tax-free cash, without having to sell your home. Think of it this way. Your home equity is like a giant block of ice frozen in a vault. It's valuable, but you can't use it to buy groceries. A reverse mortgage is like a faucet that lets you tap into that vault and get a steady stream of water, or in this case, cash, whenever you need it. Now, this isn't free money. It's a loan that accrues interest and fees just like any other. But here is the revolutionary difference. With a reverse mortgage, you are not required to make a single monthly mortgage payment for as long as you live in the home. No principal, no interest. Nothing. The loan only becomes due when the last borrower, either you or your spouse, sells the home, moves out permanently, or passes away. At that point, the loan plus all the accrued interest is paid back, typically from the sale of the house. Whatever money is left over, the remaining equity, goes to you or to your heirs. Your estate. So who can even get one of these? The most common type of reverse mortgage in the United States is called a HECM, which stands for Home Equity Conversion Mortgage. It's insured by the Federal Housing Administration, the FHA, which is part of the U.S. government. And to qualify, you generally need to meet a few key requirements. First, the big one: age. You, or at least one of the borrowers, must be 62 years of age or older. This is a program designed specifically for seniors. Second, homeownership. You have to own your home, and it must be your primary residence. This can't be a vacation home or a rental property. This is for the roof over your head. And third, equity. You need to have a significant amount of equity built up. This is the most important part. You either need to own your home outright with no mortgage left, or have a very small remaining mortgage balance. Why? Because the reverse mortgage is going to pay off your existing mortgage first before you see a single dime. The whole point is to eliminate your monthly mortgage payment and then give you access to the cash that's left over. So, if you're 62 or older, you live in your home and you have a lot of equity, you've just cleared the first hurdle. You are potentially a candidate. But this is where the real questions begin. The simple explanation sounds great. Maybe even too good to be true. A loan where the bank pays me and I don't have to make monthly payments? What's the catch? How exactly do you get the money? Is it a giant lump sum check? Is it a monthly payment like a paycheck? Is it a line of credit you can draw on like a credit card? And what about the big scary questions that keep people away? Do you still own your home? The answer is yes, but we need to talk about what that really means. What happens to your kids? Will they be stuck with a massive bill? And the biggest fear of all, can the bank just show up one day and kick you out onto the street? These are the critical questions we need to answer. And we will. So let's start with the biggest, most terrifying question of them all. Can the bank take your home? The short answer, and I want you to hear this loud and clear, is no. A reverse mortgage is not a magic trick the bank uses to steal your house. You retain the title. You own your home just like you do now. The bank cannot just decide one day that they want it and kick you to the curb. That is a myth, born from a misunderstanding of how these loans actually work. However, and this is the most important however, you will hear you do have responsibilities. Think of it like any homeownership. You have to pay your property taxes. You have to maintain your homeowner's insurance. And you have to keep the house in good condition. If you stop doing those things, you can get into trouble. But notice, that's not the reverse mortgage lender taking your home. It's you failing to meet the basic obligations of owning any home. If you don't pay your property taxes, the county can foreclose, whether you have a reverse mortgage or not. So, as long as you hold up your end of the bargain, pay your taxes, pay your insurance, and maintain the property, you can live in that home for the rest of your life without ever making a single mortgage payment. That is the fundamental promise. Now, with that fear addressed, let's peel back the layers and understand what this thing actually is. The name itself is the best clue. A reverse mortgage. Let's think about the mortgage you're probably familiar with, the one you spent 30 years paying off. We'll call that a forward mortgage. You started with a big loan balance, say $200,000, and zero equity. Every single month you sent a check to the bank. And with every payment, two things happened. Your loan balance went down and your home equity, the part of the house you truly own, went up. It's like climbing a mountain. You start at the bottom with a huge debt, and you slowly, painfully climb your way to the top where you're debt-free and own the whole thing. A reverse mortgage does the exact opposite. It flips the entire concept on its head. You start at the top of the mountain. You've paid off your house, you have all this equity built up. Let's say it's worth $400,000. But that wealth is trapped. It's not cash. You can't buy groceries with your living room. A reverse mortgage is a tool designed to unlock that trapped wealth. Instead of you sending a check to the bank every month, the bank starts sending money to you. As you receive this money, your loan balance goes up and your equity goes down. You're not climbing the mountain anymore. You're taking a comfortable ski lift down, using the value you built up over decades to fund your retirement. The loan is typically not repaid until you sell the home, move out permanently, or pass away. So you get the cash now, and the loan is settled later from the proceeds of the home's sale. That's the reverse in a nutshell. You're converting home equity back into cash without having to move. Okay, so who can actually get one of these? It's not for everyone. The most common type of reverse mortgage, the one that makes up over 95% of the market, is called a HECM, which stands for Home Equity Conversion Mortgage. It's the only one insured by the Federal Housing Administration, the FHA, which gives it a powerful layer of safety and security for the homeowner. To qualify for a HECM, you generally need to meet 3 main criteria. First, age. At least one homeowner must be 62 years of age or older. This isn't an arbitrary number. These loans were specifically designed by the government to help seniors age in place and supplement their retirement income. This is a financial tool for a specific stage of life. Second, home equity. You need to have a significant amount of equity in your home. This makes sense, right? The entire loan is based on the value you've already built up. You can't pull cash out of your home if there's no cash value in it. For most people, this means their original mortgage is either completely paid off or has a very small remaining balance. If you do still have a mortgage, that's okay. The first thing you do with the reverse mortgage funds is pay off that old loan. This immediately accomplishes a huge goal for many retirees. It eliminates their monthly mortgage payment for good. And third, it must be your primary residence. This has to be the home you live in. You can't get a reverse mortgage on a vacation home in Florida or a rental property you own across town. The program is designed to help you stay in your home, the one filled with memories, in the neighborhood you know and love. So, if you're over 62, you live in your home and you have a good chunk of equity, you're likely a candidate. Now we get to the exciting part. How do you actually get the money? This is where the flexibility of a reverse mortgage really shines, because it's not a one-size-fits-all deal. You have options. The first option is a lump sum payment. This is exactly what it sounds like. You get a single large tax-free payment right at the beginning. This can be a great option for someone who has a specific, immediate need. Maybe you need to pay off high-interest credit card debt that's been weighing you down. Or maybe you want to do a major home renovation, like making your bathroom more accessible or finally building that dream kitchen. You get the cash, you solve the problem, and you're done. The second option is monthly payments. This is incredibly popular because it feels like getting a new paycheck, a steady stream of income you can count on. It transforms your house from a monthly expense into a monthly asset. And even here you have choices. You can choose to receive a set payment every month for a specific period of time, say 10 years. Or, and this is a powerful choice, you can opt for what's called a 10-year payment. This means the bank will send you a check every single month for as long as you live in that home. Whether you live there for 5 years or 35 years, that check will keep coming. For people worried about outliving their savings, this can provide an incredible sense of security and peace of mind. The third option, and for many people the most strategic, is a line of credit. This works a lot like a home equity line of credit or HELOC, but with a few game-changing differences. You're approved for a certain amount of money, and you can draw from it as you need it. Need a new roof? Take out the $10,000. Car breaks down? Pull out $5,000 for repairs. Need to help a grandchild with college? It's there. You only pay interest on the money you actually use. But here's the truly amazing feature of a HECM line of credit, something most people don't know. The unused portion of your line of credit grows over time. That's right, it increases. If you're approved for a $200,000 line of credit and you don't touch it, next year it might be worth $210,000. It's a standby emergency fund that gets bigger all by itself, regardless of what the housing market is doing. Whether your home's value goes up, down, or sideways, that line of credit is guaranteed to grow. It is a powerful, powerful financial safety net for the future. And of course, you can combine these options. You could take a small lump sum up front to pay off a car loan, set up a monthly payment to supplement your Social Security, and leave the rest in a growing line of credit for emergencies. The flexibility is designed to fit your specific life circumstances. So let's recap where we are. A reverse mortgage is not a way for the bank to take your home. It's a government-insured loan for people 62 and older that lets you convert your home equity into tax-free cash. You can get that cash as a lump sum, as a monthly paycheck, or as a flexible line of credit that grows. You continue to own your home and you can live there for the rest of your life, as long as you do the 3 things any homeowner has to do. Pay your property taxes, pay your insurance, and maintain the property. This all sounds pretty good, right? It can be. But we're only scratching the surface. The next obvious question, the one that's probably burning in your mind right now, is, how much? How much money can I actually get? How does the bank decide if I can get $50,000 or $300,000? It's not just based on your home's value. There's a specific calculation that involves your age, current interest rates, and the value of your home. And understanding that calculation is the key to knowing if this is truly the right tool for you. So let's break down that calculation. Imagine it as a 3-legged stool. If any one leg is weak or short, the whole thing gets wobbly. The 3 legs are your age, the current interest rate environment, and your home's value. But they don't just add them up. They interact in a very specific way to produce what's called a principal limit. That's the official term for the total amount of money you can access. Let's start with the first and maybe most important leg, your age. Specifically, the age of the youngest borrower on the title. If you're married and applying together, it doesn't matter if one of you is 85. If the other is 63, the entire calculation is based on the 63-year-old. Why? Because the loan is designed to last for the rest of your life, as long as you live in the home. The lender and the FHA who insures these loans are using actuarial tables, the same kinds of tables life insurance companies use, to estimate how long the loan might be outstanding. The fundamental principle is this: the older you are, the more money you can borrow as a percentage of your home's value. A 62-year-old might be able to access, say, 40% of their home's value, while an 82-year-old might be able to access over 60%. It sounds a bit morbid, but the logic is straightforward. A younger borrower has a longer life expectancy, which means there's more time for interest to accrue on the loan balance. To ensure the loan balance doesn't grow to exceed the home's value too quickly, they offer a smaller amount up front. For an older borrower, the time horizon is shorter, so there's less risk of the interest growing out of control. Therefore, they can safely be given access to a larger portion of the equity from day one. This single factor, the age of the youngest borrower, is the bedrock of the entire calculation. It sets the initial ceiling. Now for the second leg of the stool. Interest rates. This one is a little counterintuitive. For a reverse mortgage, you actually want interest rates to be low when you apply. This is the opposite of how we think as savers, where we want high rates on our savings accounts. The rate that matters here is called the expected rate. It's a benchmark rate based on long-term market indicators, and it's used to project how much interest will likely accrue on your loan over your lifetime. Here's why it's so important. If the expected rate is low, the government's formula assumes your loan balance will grow more slowly. Think of your home's equity as a big tank of water. The loan you take out is the water you use, and the interest is a slow, steady leak. A low interest rate is like a tiny pinprick leak. It means the water level, your remaining equity, will go down very slowly. Because the risk is lower, the lender can let you take more water out of the tank from the start. Conversely, if the expected rate is high, the formula assumes your loan balance will grow much faster. That's a bigger leak in the tank. To protect you, the lender, and the FHA insurance fund, they have to limit how much you can take up front. They give you a smaller initial amount to ensure that even with a faster growing balance, you won't run out of equity. So timing can matter. Applying for a reverse mortgage during a period of lower interest rates will generally result in a higher principal limit, more available cash, than applying when rates are high. And that brings us to the third leg, your home's value. This seems simple, right? You get an appraisal and that's the number. Well, mostly. The calculation uses your home's appraised value, but only up to a certain limit set by the FHA. This is called the maximum claim amount. Each year, the FHA adjusts this limit. For 2024, for example, that limit is $1,149,825. Here's what that means in practice. Let's say your home is appraised for $400,000. Since that's well below the FHA limit, your calculation will be based on the full $400,000. Simple. Now let's say you live in a high-cost area, and your home is appraised for $800,000. Again, no problem. Your calculation is based on the $800,000. But what if your home is appraised at $2 million? Your calculation will not be based on $2 million. It will be capped at the FHA's maximum claim amount of just over $1.1 million. This is a crucial safety measure. It prevents the program from taking on massive, outsized risk on ultra-high value properties, and keeps the insurance fund solvent for everyone. So the third leg is the lesser of your home's appraised value, or the current FHA maximum lending limit. Okay, so we have our three legs: age, interest rate, and home value. How do they come together? They are plugged into a complex FHA formula that generates a magic number. This number is a percentage, and it's called the principal limit factor, or PLF. Every combination of age and expected interest rate has a corresponding PLF. Lenders have giant tables full of these percentages. Let's invent a couple to see this in action. Let's call them David and Sarah. Sarah is the younger of the two, at 70 years old. They live in a home that was just appraised for $500,000, which is well under the FHA limit. Let's assume that at the time they apply, The current expected rate leads to a principal limit factor for a 70-year-old of 52%. So, the first step is to apply that factor to their home value. $500,000 times 52%. That equals $260,000. Now, this is the most common point of confusion. David and Sarah do not get a check for $260,000. This number, the $260,000, is their gross principal limit. It's the total pot of money available for the entire life of the loan. From this pot, several things must be paid off first before they see a single dollar. First and foremost, any existing mortgage. This is a non-negotiable rule. A reverse mortgage must be the primary or only lien on the property. Let's say David and Sarah still owe $80,000 on their original mortgage. That $80,000 has to be paid off immediately using the reverse mortgage funds. So, we take their gross limit of $260,000 and subtract the $80,000 mortgage payoff. That leaves them with $180,000. But we're not done. Next come the loan's closing costs. Just like when you bought your home, a reverse mortgage has fees. These include things like an origination fee for the lender, a mandatory FHA mortgage insurance premium, an appraisal fee, title search, and other standard closing costs. These costs can vary, but let's estimate them for David and Sarah at around $15,000. This amount is also paid directly from the loan proceeds. So, we take the remaining $180,000 and subtract the $15,000 in costs. What's left? $165,000. This is the number that matters. This is their net principal limit. It's the actual, tangible, spendable amount of their home's equity that David and Sarah have unlocked. Their single biggest monthly bill, that $80,000 mortgage payment, is now gone forever. And on top of that, they now have access to $165,000 in tax-free cash that they can use for whatever they want. This final number, this net amount, is the result of that three-legged stool calculation. It's a function of Sarah's age, the interest rate environment when they applied, and their home's value, minus their existing debts and the costs to set up the loan. Every single person's calculation will be different. A 62-year-old neighbor with the same $500,000 home might only have a net amount of $90,000 after paying off their mortgage. An 85-year-old down the street might have access to over $200,000. It is completely personalized. So now that David and Sarah have their number, $165,000, the next big question arises. How do they actually get that money? Do they get it all at once in a big check? Can they take it out as a monthly paycheck? Or can they just leave it sitting there like a rainy day fund? The answer is they have a choice. And the option they choose has a massive impact on how the loan works for them over the next 10, 20, or 30 years. So let's break down those options, because this isn't a one-size-fits-all situation. Think of it like going to a restaurant. You don't just order food. You look at the menu. You have appetizers, main courses, desserts. With a reverse mortgage, you have a menu of choices for how you get your money, and each one is designed for a different appetite, a different financial goal. The first and most straightforward option is the lump sum payout. This is exactly what it sounds like. The bank cuts you one big check for the full amount you're approved for. Boom! It's in your account. Now, why would someone choose this? Well, imagine a couple, let's call them Bill and Diane. They're 68 years old, and they still owe $60,000 on their original mortgage. That payment every month is a constant source of stress. On top of that, their roof is on its last legs, and they just got a quote for $25,000 to replace it. They don't have $85,000 sitting around. For them, a lump sum is a silver bullet. They take out a reverse mortgage, get a single payment for, say, $90,000. The very next day, they pay off their old mortgage. Gone. Forever. No more monthly mortgage payments. Then they write a check to the roofer. The house is secure, their biggest monthly bill is eliminated, and they have a little left over for peace of mind. For big, immediate, one-time needs like paying off debt or major home repairs, the lump sum can be a lifesaver. But there's a critical catch. You have to understand this. The moment that $90,000 hits their account, the interest meter starts running on the entire amount. It's like taking out a $90,000 loan all at once. This means their loan balance will grow faster, and their home equity will shrink faster compared to other options. It also presents a huge temptation. Having a large sum of money suddenly appear in your bank account can make you feel richer than you are, and it can be easy to spend it on things that aren't truly necessary. So, the lump sum is a powerful tool, but it's a bit of a blunt instrument. It's for solving big problems right now. Now, let's look at the second category on our menu: monthly payments. This is for people with a completely different need. This isn't about solving one big problem. It's about solving 1,000 little ones every single month. This is for the person who looks at their Social Security check and their small pension and realizes there's a gap between what's coming in and what's going out. Within this category, there are two main flavors. The first is called a term payment. With this, you and the lender agree on a set period of time, say 10 years. For the next 120 months, you get a fixed, predictable check. It's like giving yourself a temporary salary. It's great for bridging a specific gap. Maybe you plan to sell the house in 8 years, or you know you have another source of income starting in 12 years. The downside is obvious. What happens in year 11? The payments stop. If you're still in the house and still need the money, you're out of luck. That's why the second flavor is so popular. It's called a 10-year payment. The name sounds a little formal, but the concept is beautiful. With a 10-year payment, you receive a check every single month for as long as you live in that home as your primary residence. Whether you live there for 5 years or 50 years, the check keeps coming. Think of a woman named Margaret. She's 75, a widow, and in great health. Her goal is simple. She wants to stay in the home she shared with her husband for 40 years. Her only problem is that rising property taxes and utility bills are eating up her fixed income. A 10-year payment is her solution. It provides a steady, reliable supplement to her Social Security. It's not a giant windfall, but it's the difference between struggling and living comfortably. It's the peace of mind of knowing that, no matter what, that extra bit of income will be there next month, and the month after that, for the rest of her life in that house. It turns her home equity into a personal pension plan. So you have the big, one-time lump sum, and you have the steady, predictable monthly payments. But there is a third option. And for many people, especially those who are planners, this is the most powerful, most flexible, and most strategically brilliant option of them all: the line of credit. Forget everything you think you know about a regular home equity line of credit, a HELOC. This is a different animal entirely. A reverse mortgage line of credit is like a financial safety net that you set up for yourself. Here's how it works. Let's say you're approved for $150,000. Instead of the bank giving you that money, they open a special account for you with $150,000 in it. Just sits there. You don't have to touch it. You don't pay any interest on it. It's simply available. Maybe one year the water heater breaks. It's a $2,000 emergency. Instead of putting it on a high-interest credit card, you simply draw $2,000 from your reverse mortgage line of credit. Now, and only now, do you start to owe interest, and only on that $2,000 you took out. The other $148,000 is still sitting there, costing you nothing. The next year you might need $5,000 for dental work. You draw it out. The flexibility is incredible. It's an emergency fund on steroids. But that's not even the most powerful part. This is the secret feature that most people don't know about, and it's a game changer. The unused portion of your line of credit grows. You heard me right. The amount of money you have available to you increases over time, every single month, at a rate that is tied to the loan's interest rate. Let me say that again because it's so important. If you have $150,000 sitting unused in your line of credit, and the growth rate is say 6%, then next year you won't have $150,000 available. You'll have $159,000 available. And this growth is guaranteed by the FHA. It continues to grow regardless of what happens to your home's value. Even if the housing market crashes and your home is worth less, your available line of credit keeps on growing. Think about the strategic power of this. A couple in their early 60s, David and Sarah, are in good shape financially right now. They don't need money, but they're smart. They're worried about the future. What if one of them needs long-term care in 15 years? That can cost a fortune. So they open a reverse mortgage line of credit for $200,000 and don't touch it. They just let it sit there and grow. In 15 years, that $200,000 might have grown to over $400,000 of available tax-free cash. It has become their long-term care insurance policy, paid for by the equity in their home. It's a rainy day fund that makes its own weather. Finally, it's important to know you don't have to be locked into just one of these. You can combine them. You could take a small lump sum up front to pay off a car loan, and then put the rest into a line of credit for future needs. Or you could set up a line of credit, and also schedule a small monthly 10-year payment to supplement your income. The system is designed to be flexible to fit your specific life situation. So we have the lump sum for big immediate needs. We have monthly payments for consistent, predictable income. And we have the line of credit for ultimate flexibility and a safety net that actually grows over time. Each one is a different tool for a different job. But as you're hearing about these options, a question is probably forming in your mind. It's the same question I would have. This all sounds great, but what's the catch? What does it actually cost? How much interest am I paying? What are the upfront fees? And who is getting rich off of this? Because nothing in life is free. And in the world of finance, you have to read the fine print. Let's pull back the curtain on that fine print, because you are absolutely right to ask where the money goes. In finance, skepticism is a superpower. So let's use it. We're going to break down every single dollar and cent of the cost of a reverse mortgage piece by piece. No jargon, no glossing over the details. Think about it like this. When you get a regular mortgage to buy a house, you know there are costs beyond the price of the home. There are closing costs, appraisal fees, title insurance points. A reverse mortgage is no different. It's a major financial product, and there are costs associated with setting it up and maintaining it. These costs fall into three main buckets: the upfront cost to get the loan, the ongoing costs while you have the loan, and the big one, the interest that accrues over time. Let's start with bucket number 1. The upfront costs. These are the fees you'll encounter before or at the closing table. First, and this one is non-negotiable, is the reverse mortgage counseling fee. Before any lender can even start an application with you, federal law requires that you speak with an independent, third-party counselor approved by the Department of Housing and Urban Development, or HUD. This is not a sales pitch. This person does not work for the lender. Their one and only job is to be your advocate. They make sure you understand exactly what you're getting into, that you've considered other options, and that all your questions are answered by an unbiased expert. This is a crucial protection built into the system for you, the homeowner. The cost for this is typically between $100 and $200, and it's often the very first money you'll spend in the process. Next up is the appraisal fee. Just like with a regular mortgage, the lender needs to know what your home is actually worth. An independent appraiser will come to your home, assess its condition, size, and location, and compare it to recently sold properties in your area to determine its fair market value. This value is critical because it determines how much money you can actually get. This fee usually runs from about $400 to $600, sometimes more in high-cost areas. Now we get to the bigger ticket items. The first is the origination fee. This is the fee the lender charges for processing, underwriting, and funding your loan. It covers their work, their overhead, their expertise, and frankly, their profit. This is how the lender makes money on the transaction. For the most common type of reverse mortgage, the FHA-insured home equity conversion mortgage, or HECM, this fee is regulated. It's calculated as a percentage of your home's value, but it's capped. A lender can't just charge whatever they want. The cap is currently set at $6,000. Now, here's a key point. Many lenders will compete on this fee. Some may charge the full amount, some may charge less, and some might even waive it as part of a promotion. This is one of the primary areas where you can and should shop around. The other significant upfront cost is the initial mortgage insurance premium, or IMIP. This is a big one, and it's probably the most misunderstood part of a reverse mortgage. This is not private mortgage insurance, or PMI, that you might have on a regular mortgage. This is a federally mandated insurance premium that you pay to the FHA. And what it buys you is the single most important protection a reverse mortgage offers: the non-recourse guarantee. Let's say that again. Non-recourse guarantee. This insurance is the magic ingredient that says you, or your heirs, will never, ever owe more than the home is worth when it's sold to repay the loan. If the housing market crashes and your loan balance is $250,000, but your home can only sell for $200,000, that $50,000 shortfall is not your problem. It's not your kid's problem. It's not a debt that gets passed on to your estate. The FHA insurance fund covers that loss. It's a safety net woven directly into the fabric of the loan. This insurance also guarantees that if your lender were to go out of business, the FHA would step in and ensure you continue to receive your payments if you've set them up that way. This one-time premium is currently 2% of your home's appraised value. So, on a $300,000 home, that's a $6,000 fee. Now you might be thinking, wow, those are some serious upfront costs. And you're right. But here's something important to know. You almost never pay for these costs out of your pocket. The counseling fee is usually the only exception. The origination fee, the appraisal, the insurance premium, and other standard closing costs like title searches and recording fees are typically rolled into the loan itself. They become part of your initial loan balance. So you don't have to write a big check, but it does mean your loan starts with a balance that's higher than the cash you actually received. That covers bucket 1. Now for bucket 2. The ongoing costs. These are the fees that are added to your loan balance over time. There are really only 2. First is a small monthly servicing fee. The company that manages your loan, sending you statements, tracking your balance, charges a fee for this service. It's usually a small fixed amount, around $30 to $35 per month. Like the upfront cost, this isn't a bill you pay. It's simply added to your loan balance each month. The second and more significant ongoing cost is the annual mortgage insurance premium. This is the little brother to that big initial premium we just talked about. This fee keeps that all-important FHA insurance and the non-recourse guarantee active for the life of the loan. It's calculated annually but accrues monthly, and it's currently set at 0.5% of the outstanding loan balance. So as your loan balance grows, this fee will also grow slightly. Again, you don't pay it. It's just added to the total you owe. And that brings us to the third and by far the largest cost component, the interest rate. This is the elephant in the room. This is the primary way the lender is compensated for giving you money for decades without receiving a single payment from you. And just like with a regular mortgage, you have choices. The interest on a reverse mortgage is compounded, meaning you're charged interest not just on the money you've borrowed, but also on the fees and the interest that have already been added to your balance. This is why the loan balance grows over time. You'll generally see 2 types of interest rates: fixed rates and adjustable rates. A fixed-rate reverse mortgage is exactly what it sounds like. The interest rate is locked in for the life of the loan. It will never change. This offers predictability, which can be very comforting. However, there's a major trade-off. With a fixed-rate HECM, you are typically required to take all of your available loan proceeds in one single lump sum at closing. You can't set up a line of credit or receive monthly payments. This can be a problem because interest starts accruing on that entire large balance from day one, whether you need all that money right away or not. The more popular and flexible option is the adjustable rate mortgage, or ARM. With an adjustable rate, you can choose how you want to receive your money. As that lump sum, as a line of credit you can draw from as needed, as fixed monthly payments, or a combination of these. The interest rate is variable, meaning it can go up or down over time. It's typically based on a benchmark index like the SOFR index, plus a margin set by the lender. For example, your rate might be the SOFR index plus a 2% margin. If the index goes up, your rate goes up. If it goes down, your rate goes down. The big advantage here is flexibility and control. If you choose a line of credit, you only accrue interest on the money you've actually used, not on the money sitting waiting for you. This can result in a much slower growing loan balance over the long run. So, to recap the costs, you have the upfront fees for setting up the loan, most of which are rolled into the balance. You have the ongoing insurance and servicing fees that are added monthly. And you have the interest, either fixed or adjustable, which is the engine that makes your loan balance grow over time. So yes, there are costs, significant ones, but each cost is tied to a specific function. Paying the people doing the work, insuring the loan against loss for both you and the lender, and compensating the lender for providing the capital. Now that we've dissected the costs, the real question becomes, how do you actually receive the money? Is it a giant check that shows up at your door? Is it a monthly deposit into your bank account? Or is it something else entirely? The way you choose to get paid can dramatically change how the loan works for you, how much it costs in the long run, and how it fits into your retirement strategy. And that's exactly what we're going to break down next. Let's dive into the 5 main ways you can receive your money, because this is where the strategy really comes into play. Think of it like a menu at a restaurant. You know you want the main dish, the reverse mortgage, but how it's prepared and served to you can make all the difference. The first and most straightforward option is the lump sum payout. This is exactly what it sounds like. After you close on the loan, the entire approved amount of cash is wired directly to your bank account. One big deposit. Boom, it's done. Now, why would someone choose this? The lump sum is typically for people who have a large, immediate financial need. The most common reason is to pay off an existing mortgage. Let's say you still owe $80,000 on your original home loan. That monthly payment is a constant drain on your retirement budget. By taking a lump sum, you can wipe that mortgage off the books entirely, and in doing so, you eliminate that monthly payment forever. This can instantly free up hundreds, or even thousands of dollars in your monthly cash flow. It can also be used for other major, one-time expenses like a significant medical bill, an urgent and costly home repair like a new roof, or helping a family member with a down payment on their own home. The benefit is obvious: you get a massive amount of cash right now to solve a big problem. But there's a significant downside you have to understand. The lump sum is the most expensive way to take your money in the long run. Why? Because interest starts accruing on the entire loan balance from day one. If you take out a $200,000 lump sum, you're paying interest on that full $200,000 from the moment it hits your account, even if you don't spend it all right away. It immediately starts eating into your home's equity at the fastest possible rate. It's a powerful tool for a specific job, but if you don't have an immediate need for all that cash, it can be a very inefficient and costly choice. The second option is what's called term payments. With this choice, you don't get a big pile of cash. Instead, the lender sends you a fixed, consistent monthly payment for a specific, predetermined period of time. You and the lender might agree that you'll receive $2,000 a month for the next 10 years. It's like getting a predictable paycheck from your house. This option is for people who have a clear timeline for their financial needs. Maybe you plan to retire at 65, but your Social Security doesn't kick in until 67. You could set up term payments to bridge that 2-year income gap. Or perhaps you have a 15-year plan for travel and hobbies and want to supplement your income during that specific window of time. The big advantage here is that it's much more cost-effective than the lump sum. You only accrue interest on the money as it's paid out to you. In that first month, you're only paying interest on the $2,000 you received, not the entire potential loan amount. This preserves your home equity for much longer. The drawback, of course, is the term limit. When the 10 years are up, the payments stop. Period. If you live another 20 years, that income stream is gone and you can't get it back. It's a fantastic tool for bridging a known gap, but it's not designed for lifelong income security. That brings us to our third option, tenure payments. This one is very similar to term payments, but with one massive, game-changing difference. Instead of receiving a monthly check for a set number of years, you receive a monthly check for as long as you live in the home. It doesn't matter if you live to be 90, 100, or 110. As long as you meet the loan obligations, paying your property taxes, your homeowner's insurance, and maintaining the home, that check will arrive every single month. This is the option for people whose number one priority is security and peace of mind. They want to create a financial bedrock, a guaranteed stream of income that they know with absolute certainty they can never outlive. It transforms a portion of your home equity into a private pension plan that you control. The upside is that incredible stability takes the fear of outliving your money off the table. The trade-off is that the monthly payment amount for a 10-year plan is typically smaller than what you could get with a term plan. The lender has to calculate the payment based on your age and life expectancy, and since they're taking on the risk that you might live for a very, very long time, they have to be more conservative with the monthly amount. You're trading a higher payment for a lifetime guarantee. Now for the fourth option, which is by far the most popular and, for many people, the most powerful, the line of credit. This works a lot like a home equity line of credit, or HELOC, that you might be familiar with, but with some incredible features you won't find anywhere else. With this option, you're approved for a certain amount of money, let's say $250,000. But instead of the bank giving it all to you at once, it sits in a standby account that you can draw from whenever you want for whatever you want. Need $5,000 for a new air conditioner? You can transfer it over. Want to take a $10,000 anniversary trip? The money is there. Want to let it sit untouched for 5 years as an emergency fund? You can do that too. The flexibility is the main appeal. But here's the most important part, the feature that makes this option so unique. The unused portion of your line of credit grows. That's right, the money you don't use actually increases over time. The growth rate is tied to the interest rate of the loan. So if your loan has a 6% interest rate, your available line of credit will also grow at a rate of 6% per year. That $250,000 credit line you didn't touch could be worth over $265,000 after the first year, and it continues to compound from there. This is a massive benefit. It means your safety net gets bigger over time, giving you more borrowing power in the future, which can be a powerful hedge against inflation. If the cost of living goes up, your available funds have also gone up to help you meet it. And just like the other options, you only pay interest on the money you actually use. If you have a $250,000 line of credit but you've only drawn $50,000, you're only accruing interest on that $50,000. The other $200,000 is sitting there, costing you nothing, and in fact growing for your future use. This makes the line of credit an incredibly efficient and powerful financial planning tool. Finally, there's the fifth option, which isn't really a separate option at all, but a combination of the others. The program is flexible enough to let you mix and match. For example, you could take a small lump sum at closing to pay off your high-interest credit cards, set up a small, monthly tenure payment to cover your utility bills for the rest of your life, and keep the remaining majority of your funds in a growing line of credit for emergencies or future opportunities. This allows you to tailor the loan precisely to your individual needs, addressing immediate problems while also planning for long-term security and flexibility. So you have the all-at-once lump sum, the temporary paycheck of term payments, the lifelong paycheck of tenure payments, the ultra-flexible and growing line of credit, or a custom-built combination of them all. The right choice isn't the same for everyone. It depends entirely on your goals, your financial discipline, and what you want your retirement to look like. Now that you know how you can get paid, the next logical question is the one on everyone's mind. Okay, but what does it all cost? What are the real numbers? Understanding the fees, the interest, and the insurance involved is the critical next step in deciding if a reverse mortgage is right for you. Let's pull back the curtain on the costs because this is where the rubber meets the road. It's also where a lot of the confusion and fear comes from. People hear horror stories about sky-high fees, and it's easy to get scared off. But the truth is, the costs aren't a mystery. They're just specific. And once you understand what each one is for, they start to make a lot more sense. Think of the costs in three main categories: the upfront cost to set up the loan, the ongoing costs that accrue over time, and the interest, which is the biggest cost of all. Let's start with the upfront costs. These are the fees you'll see on your settlement statement, very similar to what you'd see with a traditional mortgage. The first, and usually the largest, is the origination fee. This is what the lender charges for their work, processing your application, underwriting the loan, and getting everything in place. Now, this isn't the Wild West. For the government-insured HECM, this fee is tightly regulated by the FHA. It's calculated based on your home's value. The lender can charge 2% on the first $200,000 of your home's value, and 1% on the value above that, but the total fee is capped. As of right now, that cap is $6,000. So, no matter if your home is worth $700,000 or $1 million, the most you can be charged for this specific fee is $6,000. Many lenders will even charge less to be competitive. Next up are the standard third-party closing costs. If you've ever bought a house or refinanced, these will look familiar. We're talking about things like the appraisal fee, to determine your home's current market value, the title search and insurance, to make sure there are no surprise claims on your property, recording fees, courier fees, and other administrative costs. These aren't paid to the lender. They're paid to the different companies that perform these essential services. Altogether, these third-party costs typically run somewhere between $1,000 and $3,000, depending on where you live. Now for a big one that's unique to HECM reverse mortgages: the initial mortgage insurance premium, or MIP. This is a crucial piece of the puzzle. This is a fee you pay directly to the FHA, and it's the bedrock of the entire program. This insurance is what provides the powerful protections we talked about earlier. It's the safety net that guarantees you'll receive your loan payments, even if your lender goes out of business. It's also the guarantee that you or your heirs will never owe more than the home is worth when the loan is repaid. It's a non-recourse loan protection. This insurance is what makes a HECM so different and so much safer than the risky private reverse mortgages of the past. The cost for this powerful protection is a one-time premium of 2% of your home's appraised value. So, on a $400,000 home, the initial MIP would be $8,000. The final upfront cost is the smallest, but it's mandatory: the fee for your HECM counseling session. This independent, third-party counseling is required by law to ensure you fully understand the loan before you commit. The cost is usually very reasonable, typically between $125 and $250. Now, you might be adding all this up in your head: the origination fee, the closing costs, that big MIP payment, and thinking, I don't have $10,000 or $15,000 sitting around to pay for this. And here is the key point. For the vast majority of borrowers, these upfront costs are not paid out of pocket. Instead, they are financed into the loan itself. They are paid from the proceeds of the reverse mortgage. So, the money you have available to you is simply your total loan amount minus these initial costs. You don't have to write a check. Okay, that covers getting the loan started. What about the ongoing costs? There are really only two to think about. The first is another form of mortgage insurance. It's the annual mortgage insurance premium. This is the little brother to the big upfront MIP we just discussed. It serves the same purpose, maintaining that FHA protection for the life of the loan, but it's calculated differently. This annual MIP is equal to 0.5% of the outstanding loan balance. It's important to understand you don't get a bill for this every year. Just like the upfront costs, this premium simply accrues. It gets added to your loan balance over time, and you pay it back all at once when the loan eventually comes due. The second potential ongoing cost is a monthly servicing fee. Some lenders charge this to cover the administrative costs of managing your account, sending statements, tracking your line of credit, and so on. This fee can be around $30 to $35 a month. However, in today's competitive market, many lenders have completely eliminated this fee. It's definitely something to ask about and compare when you're shopping for a lender. And that brings us to the third and most significant cost of a reverse mortgage: the interest. This is where the concept of a reverse mortgage really flips traditional thinking on its head. With a regular mortgage, you pay interest to the bank every month. With a reverse mortgage, you don't make monthly payments. Instead, the interest accrues, meaning it gets added to your loan balance each month. Your loan balance grows over time. This is a concept called negative amortization, and it's the fundamental trade-off of the product. You're trading future home equity for access to cash today, without the burden of a monthly payment. The interest rates themselves come in two main flavors: fixed and adjustable. A fixed rate is exactly what it sounds like. You lock in one single interest rate for the entire life of the loan. It's predictable and simple. However, fixed rates are typically only available if you take all your available loan proceeds as a single lump sum at closing. More common is the adjustable rate mortgage, or ARM. This is required if you want the flexibility of a line of credit or monthly payments. An adjustable rate is made of two parts: a benchmark index, which goes up and down with the market, plus a fixed margin, which is the lender's profit. So your rate can change over time. Now, these ARMs have lifetime caps, so there is a limit to how high your rate can ever go. But the fact remains, there is an element of uncertainty. If market rates go up, the interest accruing on your loan will go up too. So let's put it all together with a quick, simplified example. Let's say your home is appraised at $500,000, and based on your age, you're eligible for a principal limit of $250,000. That's your total borrowing power. From that $250,000, we subtract the finance closing costs. The upfront MIP would be 2% of the home value, so that's $10,000. Let's estimate the origination fee and third-party costs at another $7,000. That's a total of $17,000 in upfront costs. So, the net amount available to you would be $250,000 minus $17,000, which equals $233,000. That is the money you can actually use either as a lump sum, a line of credit, or monthly payments. And from that day forward, the loan balance starts to grow. The initial $17,000 in costs is now part of your balance, and interest begins to accrue on it. If you draw another $50,000, your balance becomes $67,000, and interest accrues on that new, higher amount. And every year, the 0.5% annual MIP is calculated on that growing balance and added to the total. It's a snowball effect by design. The balance is meant to grow because you are not paying it down. Seeing that loan balance climb can be unsettling. It's the complete opposite of everything we've been taught about finances our entire lives. And it leads to the single most terrifying question people have about reverse mortgages, the one that keeps them up at night. With all these costs and all this accruing interest piling up, year after year, is it possible to owe more than the home is worth? What happens if the housing market crashes? Can the bank come after my other assets? And what about my kids? Will they be saddled with a massive bill they can't possibly pay? These are the fears that fuel the biggest myths and misconceptions about reverse mortgages, and it's time to face them head-on. Let's start with the biggest, scariest monster in the room, the one that whispers in your ear late at night. If you do this, the bank will own your home. This single fear is probably responsible for 90% of the hesitation around reverse mortgages. It's a powerful, terrifying image, a faceless corporation snatching the deed to the home you've poured your life into. But here is the stone-cold, legally binding truth. It is completely 100% false. When you take out a reverse mortgage, you retain the title to your home. Your name stays on the deed. It is your property. Just like with a traditional mortgage, the bank or lender simply has a lien on the property, which is a legal claim that serves as collateral for the loan. Think about it. When you bought your house 30 years ago with a regular mortgage, did the bank own it? No, you did. The bank just had a financial interest in it until you paid them back. A reverse mortgage works on the exact same principle of ownership. The only thing that's changing is the direction the money is flowing. With a traditional mortgage, you start with a big loan balance and make monthly payments to shrink it down to zero. With a reverse mortgage, you start with the loan balance of zero, and it grows over time as you receive payments or draw from your line of credit. But in both scenarios, the house is unequivocally yours. You can paint the walls, renovate the kitchen, plant a garden, all the things a homeowner does because you are the homeowner. The bank can't tell you what to do with your property any more than they could when you had a regular mortgage. So let's slay that first monster right now. The bank does not take your home. You remain the owner, period. Now for the second monster, and this one is often even more emotional. It's the fear for your children, for your legacy. The question is, if I die and the loan balance is more than my house is worth, will my kids be on the hook for the difference? Will they inherit a mountain of debt? This is a noble and important concern. You've worked your entire life to provide for your family, and the last thing you want is to leave them with a financial nightmare. Well, I have some incredibly good news. The answer is a resounding absolute no. Your heirs will never, ever owe more than the value of the home. This is guaranteed by the fundamental structure of the Federally Insured Home Equity Conversion Mortgage, or HECM, which is the most common type of reverse mortgage. It is what's known as a non-recourse loan. That's a fancy term, but the concept is beautifully simple. It means the lender can only look to one asset for repayment of the debt: the house itself. They cannot touch your heirs' savings accounts, their retirement funds, their cars, or any other asset. The house pays the debt, not your family. Let's play this out with a real-world example. Let's say you take out a reverse mortgage and live happily in your home for 20 years. When you pass away, the loan balance has grown to $350,000. But imagine the housing market has taken a downturn, and the appraised value of your home is only $300,000. That's a $50,000 shortfall. Your kids are looking at this and thinking, oh no, we're going to have to come up with 50 grand. But that's not what happens. Remember that mortgage insurance premium, the MIP, that we talked about earlier? This is precisely what it's for. That insurance fund, backed by the FHA, steps in and pays the lender that $50,000 difference. The lender is made whole. Your kids can then allow the lender to sell the house for $300,000 to satisfy the debt, and they can walk away, owing absolutely nothing. Their inheritance isn't a bill. It's simply zero in this worst-case scenario. They are completely protected. Now let's flip that scenario. What if the opposite happens? The loan balance is $350,000, but your home is now in a desirable neighborhood, and its market value has soared to $500,000. What happens then? This is where your legacy is truly preserved. Your heirs have a choice. They can sell the house for $500,000, use $350,000 of that to pay back the loan in full, and they get to keep the remaining $150,000 in tax-free cash. That's their inheritance. Alternatively, if one of your children wants to keep the family home, they have the option to refinance the loan for the amount owed, $350,000, and take out a new mortgage in their own name. The remaining $150,000 in equity is theirs. In every scenario, your heirs are in control. They are protected from any downside and they get to benefit from any upside. The idea that you're saddling your kids with debt is not just a myth. It's the literal opposite of how the program is designed to work. It's designed to protect them. Okay, 2 monsters down, 1 to go. This last one is the fear of being displaced. The worry that the bank can suddenly show up and kick you out onto the street. What if I outlive the loan? What if I use up all the money? Will they foreclose on me? The core promise of a reverse mortgage is that you can stay in your home for the rest of your life. And that promise holds true as long as you, the homeowner, hold up your end of the bargain. This isn't a free pass to ignore your responsibilities as a homeowner. The loan agreement is very clear on what you need to do to keep it in good standing. There are 3 main requirements. First, you must live in the home as your primary residence. This makes sense. The program is designed to help seniors stay in their homes, not to finance rental properties. Second, you must pay your property taxes and your homeowner's insurance on time. This is the exact same requirement you'd have with a traditional mortgage, or even if you owned your home outright. If you don't pay your taxes, the county can put a lien on your house and eventually foreclose, regardless of what kind of mortgage you have. And if you don't have insurance and the house burns down, the lender's collateral is gone. So these rules are in place to protect everyone involved. The third requirement is that you must maintain the home and keep it in good repair. Again, this is about protecting the value of the asset. The lender isn't going to send someone over with a white glove to check for dust, but they do expect you to fix a leaky roof or deal with a major structural issue. As long as you meet these 3 basic obligations, live in the home, pay your taxes and insurance, and maintain the property, you can never be forced to leave. It doesn't matter if your loan balance grows to be more than the home is worth. It doesn't matter if you live to be 110 years old. You cannot be kicked out. The loan does not become due until the last surviving borrower either passes away or permanently moves out of the home, for example, into a long-term care facility for more than 12 consecutive months. So the fear of being kicked out is only a reality if you fail to meet the same basic responsibilities that every single homeowner has. It's not some special gotcha clause hidden in the fine print of a reverse mortgage. We've faced down the 3 biggest monsters. The bank doesn't take your home. Your kids will never be stuck with a bill. And you can't be kicked out as long as you take care of your homeowner duties. By clearing away this fog of fear, we can start to see the reverse mortgage for what it actually is. But that doesn't mean it's a magic wand. This isn't free money, and it's not without its own costs and complexities. Now that we've busted the myths, it's time to get into the numbers and talk about the real tangible costs you can expect to pay. What are the closing costs? How are the interest rates calculated? And what about those fees we've mentioned? Let's dive right into the heart of the matter, the money. Because understanding a reverse mortgage isn't just about concepts and theories. It's about knowing exactly what it will cost you. This is where the rubber meets the road, so let's break down every single fee, percentage, and cost piece by piece. There are 3 main categories of costs you need to be aware of: the upfront costs to get the loan, the ongoing costs that accumulate over time, and the costs when the loan eventually comes due. We'll start with the first hurdle, the upfront closing costs. Just like when you bought your home, a reverse mortgage has a set of initial fees. The good news? You almost never pay for these out of your pocket. They are typically rolled right into the loan balance itself. First up is the origination fee. This is the fee the lender charges for processing, underwriting, and creating your loan. Think of it as their payment for the work involved in setting everything up. For a home equity conversion mortgage, or HECM, which is the most common type, this fee is regulated by the FHA. It's calculated as 2% of the first $200,000 of your home's value, plus 1% of the amount over $200,000. However, there's a cap. The total origination fee can never exceed $6,000. So if you have a home valued at $800,000, the fee isn't some astronomical number. It's capped at that $6,000 ceiling. Some lenders might charge less, making it a point of competition, so it's something you can shop around for. Next, you have standard third-party closing costs. If you've ever bought a house or refinanced, these will look very familiar. We're talking about things like an appraisal fee to determine your home's current market value, a title search and title insurance to ensure there are no other claims on your property, a credit report fee, a flood certification, recording fees, and other miscellaneous administrative costs. These aren't paid to the lender. They're paid to the various third-party companies that perform these essential services. These costs can vary significantly depending on where you live, but you can generally expect them to be in the range of a few $1,000s. Now we come to the most significant upfront cost, and it's one that's unique to HECM reverse mortgages: the initial mortgage insurance premium, or IMIP. This is a one-time fee paid directly to the FHA. The current rate is a flat 2% of your home's appraised value. So, on a $400,000 home, the IMIP would be $8,000. I know what you're thinking. $8,000? For insurance? Sounds like a lot, and it is. But this insurance is the secret sauce that makes a reverse mortgage work and provides its most powerful protections. This isn't insurance for you in the traditional sense. It's insurance for the entire system. It's what funds the guarantee that you will always receive your loan payments, even if your lender goes out of business. More importantly, it's what funds the non-recourse feature we talked about earlier. The absolute promise that you or your heirs will never owe more than the home is worth when the loan is repaid. This single premium is your ticket to peace of mind, ensuring that a market downturn won't leave your family with a massive bill. It's a steep price, but it's for an ironclad guarantee. So, to recap the upfront costs, you have the lender's origination fee, the standard third-party closing costs, and the FHA's initial mortgage insurance premium. Again, all of these are typically just added to your initial loan balance. Now let's move on to the ongoing costs. These are the costs that cause your loan balance to grow over time. The biggest and most obvious one is the interest rate. With a reverse mortgage, you're not making monthly payments. So the interest that accrues each month is simply added to the total amount you owe. Reverse mortgages come in two flavors: fixed rate and adjustable rate. A fixed rate loan is only available if you take all your money as a single lump sum at closing. The rate is locked in for the life of the loan. It's predictable, but it's also inflexible. The vast majority of borrowers, especially those who want a line of credit or monthly payments, will get an adjustable rate mortgage. This is the one we need to really understand. An adjustable rate isn't just one number. It's made of two parts: the index and the margin. The index is a benchmark interest rate that reflects general market conditions. It goes up and down with the economy. For most HECMs today, the index used is called the SOFR, or the Secured Overnight Financing Rate. You don't need to know the complex details, just think of it as the wholesale cost of money that the lender has to pay. It can change over time. The second part is the margin. This is a fixed percentage that the lender adds on top of the index. This is the lender's profit. The margin never changes for the entire life of your loan. So your total interest rate at any given time is the current index rate plus the lender's fixed margin. For example, if the SOFR index is at 3% and the lender's margin is 2.5%, your effective interest rate would be 5.5%. If the index rises to 4% next year, your rate would become 6.5%. Your loan documents will also specify a lifetime cap on the interest rate, so you're protected from a worst-case scenario of runaway inflation. Beyond the interest, there are two other ongoing costs. The first is the annual mortgage insurance premium. This is the smaller ongoing cousin of that big upfront IMIP. It's calculated at a rate of 0.5% of your outstanding loan balance each year. This ongoing premium continues to fund those FHA guarantees we discussed, protecting both you and the lender throughout the life of the loan. This amount is also added to your loan balance, not paid out of pocket. Finally, some lenders may charge a monthly servicing fee, typically around $30 to $35. This fee covers the cost of managing your account, sending you statements, and handling the administrative side of the loan. However, many lenders have stopped charging this fee to be more competitive, so it's another point to compare when you're shopping for a loan. Okay, that was a lot of percentages and terminology. Let's make it real with an example. Let's imagine a homeowner named Robert. He's 72 years old, and his home is appraised at $500,000. He has a small remaining mortgage of $20,000 that he wants to pay off. Based on his age and current interest rates, let's say the lender determines his principal limit. The total amount of money he can access is $265,000. That's his total borrowing power. Now let's deduct the upfront costs. First, the origination fee. It's 2% of the first $200,000, $4,000, plus 1% of the remaining $300,000, $3,000. That's a total of $7,000, but it's capped at $6,000. So his origination fee is $6,000. Next, the initial mortgage insurance premium, IMIP. That's 2% of his home value, so 2% of $500,000 is $10,000. Then, let's estimate his third-party closing costs at $3,500. So the total upfront fees are $6,000 plus $10,000 plus $3,500, which equals $19,500. We also have to pay off his existing mortgage of $20,000. So, from his total borrowing power of $265,000, we subtract the $19,500 in fees and the $20,000 mortgage payoff. That leaves Robert with $225,500 in net proceeds. This is the money he can take as a lump sum, set up as monthly payments, or keep as a line of credit that will grow over time. His starting loan balance will be the sum of the fees and the mortgage he paid off, totaling $39,500. From that day forward, interest and the annual MIP will begin to accrue on that balance, and on any additional funds he draws. Seeing it all laid out like that can be a little jarring. The costs are not insignificant, but it's crucial to frame them correctly. You are not just paying fees, you are purchasing a unique financial product designed for a very specific purpose, to allow you to access your home equity without having to make monthly payments, while providing an ironclad guarantee that you can stay in your home and will never owe more than its value. The costs are the price of those powerful benefits. Now that you have a crystal clear picture of the costs involved, a new set of questions emerges. How do you actually apply? What documents do you need? And how do you navigate the process from that initial counseling session all the way to closing? Most importantly, after hearing all of this, how do you make the final, crucial determination of whether a reverse mortgage is truly the right move for your specific situation? We're going to walk through that final checklist next. Alright, let's build that final checklist. This is where the rubber meets the road. It's the framework you can use to filter out all the noise and make a decision that you can feel confident in, not just today, but for years to come. I want you to grab a pen and paper, or open a new note on your phone, and seriously consider these 3 critical questions. The first question is the most important. What is my fundamental why? This isn't about just wanting more money. You have to go deeper. Are you considering a reverse mortgage to cover essential, non-negotiable living expenses? Things like property taxes you can no longer afford, critical home repairs to keep your house safe and livable, or in-home healthcare that allows you to age in place with dignity. If your why is rooted in necessity, in solving a problem that, if left unsolved, would force you out of your home or into a precarious financial state, then a reverse mortgage sits on one side of the scale. It's a tool designed for this exact scenario. But what if your why is different? What if it's for discretionary spending, a long-awaited world cruise, a brand new RV, or helping your grandkids with a down payment on their own house? These are all wonderful things, but they are wants, not needs. And using a reverse mortgage to fund them is a fundamentally different proposition. You are essentially borrowing against your home at a significant cost to pay for lifestyle upgrades. There's no right or wrong answer here, but you must be brutally honest with yourself. Are you willing to trade a large portion of your home's future value and your heirs' inheritance for that goal? If the answer is yes, that's your choice. But go into it with your eyes wide open, understanding the true long-term cost of that vacation or vehicle. Your why dictates everything. The second critical question is, what are my alternatives and what is my plan B? A reverse mortgage should never be the first and only option you consider. It should be the last option, after you've thoroughly explored and ruled out everything else. Have you looked into a traditional home equity line of credit, or HELOC? If you can still handle a monthly payment, even a small one, a HELOC is almost always cheaper and more flexible. Have you considered a cash-out refinance? Again, it involves payments, but the interest rates and fees are typically much lower. And then there's the biggest alternative of all, downsizing. This is the conversation many people want to avoid, but it's one of the most powerful financial moves you can make in retirement. Selling a large family home, paying cash for a smaller, more manageable condo or house, and investing the leftover profit can often create a stream of income that far surpasses what a reverse mortgage could provide. It eliminates a huge chunk of maintenance, property taxes, and utility bills. It's a massive emotional decision, I get that. But you have to run the numbers. You owe it to yourself to see what that financial picture looks like. Beyond the alternatives, you need a plan B. The biggest risk with a reverse mortgage is the unknown. What happens if you need to move into an assisted living facility 2 years after taking out the loan? The loan becomes due and payable. Your home will have to be sold. After paying off the loan balance, which will have grown because of interest and insurance premiums, how much will be left over? Will it be enough to cover the high costs of long-term care? You need to project these scenarios. Think like a chess player, always considering the next few moves. A reverse mortgage can feel like a safety net, but you need a safety net for your safety net. And that brings us to the third and final question on our checklist. Who have I talked to about this? And I don't just mean the loan officer. The first conversation you must have is with your family, especially any children who might be expecting to inherit the home. This is not about asking for permission. You are the homeowner. It is your equity, your decision. This is about managing expectations and preventing future heartbreak and resentment. The conversation can be simple. You can say, "We're exploring some financial options to help us stay in our home and be more comfortable in retirement. One of those options is a reverse mortgage. I want you to understand what that is and how it would work. It means that when we pass away, the house will likely need to be sold to pay back the loan, and the remaining amount, if any, would be your inheritance." That's it. You are providing information. You are giving them time to process it, ask questions, and understand the reality of the situation. A financial surprise on top of the grief of losing a parent is a terrible burden to place on your children. This conversation, as difficult as it might be, is a gift. The second conversation you need to have is with an independent third-party professional. This is non-negotiable. I'm talking about a fiduciary financial advisor. A fiduciary is legally and ethically bound to act in your best interest. Not the lender's interest, not their own interest, but your best interest. They can look at your entire financial picture, your savings, your social security, your pension, your expenses, and give you an unbiased opinion on whether a reverse mortgage fits into your overall plan, or if there are better strategies you haven't considered. The fee you pay for a few hours of their time could save you tens of thousands of dollars and a world of regret down the line. And finally, you must complete the FHA-mandated counseling session. Do not treat this as a box to be checked. Treat it as a fact-finding mission. The counselor works for you. They are paid to be your advocate. Come prepared with a list of questions. Ask them to explain the total annual loan cost, or TALC rate. Ask them to walk you through the amortization schedule, showing how the loan balance will grow over time. Ask them about the specific scenarios that would make the loan come due. Squeeze every drop of value out of that session. So let's recap the final checklist. 1. What is my fundamental why? Is it for a need or a want? 2. What are my alternatives and what is my plan B? Have I truly explored downsizing or a HELOC? 3. Who have I talked to? Have I had the tough conversation with my family and sought unbiased advice from a fiduciary? If you go through this process honestly, the right answer for you will become much, much clearer. Over this entire series, we've taken a deep dive into one of the most misunderstood financial products in America. We've seen that a reverse mortgage is not free money. It is a loan, a complex and expensive loan that uses your home as collateral. It allows you to access your equity without monthly payments, which can be a lifeline for seniors who are house-rich and cash-poor, enabling them to stay in their beloved homes. But it comes at a cost. The high upfront fees, the compounding interest and mortgage insurance, the steady erosion of your equity, and the significant impact on your heirs' inheritance. It's a powerful tool, but it has sharp edges. And whether it's the right tool for you depends entirely on your unique situation. Ultimately, this decision isn't just about money. It's about what you want your retirement to look like. It's about your peace of mind, your independence, and your legacy. There is no single answer that fits everyone. The only person who can decide if the benefits outweigh the significant costs is you. My goal with this series was never to tell you whether to get a reverse mortgage. It was to give you the knowledge and the framework to make that decision for yourself, with confidence and clarity. To cut through the marketing jargon and the sales pitches and get to the truth. If you found this information valuable, if it's helped you feel more empowered on your journey, a simple like on this video helps us reach and help more homeowners just like you. Be sure to subscribe so you don't miss out on future deep dives into the financial topics that matter most. And now I want to hear from you. The comment section is a space for our community to learn from each other. Have you or a loved one gone through the reverse mortgage process? What was your experience? What do you wish you had known before you started? Your story, your single piece of advice, might be the exact thing someone else needs to read today to make the best choice for their family. Thank you for taking the time to educate yourself on this incredibly important topic. Whatever you decide, I wish you a safe, secure, and fulfilling retirement.